Okay, let's talk about what we've done and what are we doing. Number one, we talked about building a foundation. What do you do before you invest? We then talked about how do you apply the principles. Hopefully, after we've talked about the principles, you've seen everything that we've done here is applying those principles. We talked about asset classes and benchmarks. Then we talked about how do you choose the right investment vehicles. We talked about what makes a good mutual fund. We came up with our risk tolerance and our asset allocation. We set our asset allocation to match our risk tolerance. And then we came up with our expected return for the portfolio. Then on Monday, we went through and how do you pick your financial assets? And instead of having you get a Morningstar account for $25 that you'll use for 15 minutes, we actually went through Learning Tool 28. We used those criteria in Morningstar and then just showed you the results. And then you can actually pick those tickers and then just go to AI and you can actually learn a lot more. So today we're going to talk about how do you monitor rebalance, and we're going to finalize that investment portfolio. So again, what did we do on Friday of last week? We did Exhibit 1, which, remember, we did our asset allocation, we did a risk tolerance test, we said how it adjusted, we came up with our expected return, our asset allocation, and then our expected returns. Then on Monday, we went through, we came up and we put our asset allocation in here, and then we picked the individual stocks for that. Panel 1 was what's our target, panel 2 was what do we own now, and panel 3 was what do we have to buy to get to our target. And then what are we going to do? We're going to finish. It's 5 pages today that we'll finish this out. So hopefully by the end of the day, today's class, you'll have a completed personal financial plan. So let's kind of summarize. What's the most important document you'll do for your investing process? And it's your investment plan. In industry, it's called an investment policy statement. You know, it's funny, most institutions, large companies, foundations are required by law to have an investment policy statement. How come individuals don't? And we think we should have one just as well. Why is it important? It just sets the framework on everything you do. What is your investment plan? What does it help you to do? It does 3 things. Number 1, represent yourself. It helps you see what your risk tolerance is. What are your personal constraints? What are your budget? It helps you see what you will and will not do. What will you invest in? What won't you invest in? What are your benchmarks and other areas relating to investing? And finally, it gives you a framework and guidelines to help you reason through decisions. Again, everything here is principles-based. So how do you monitor? Once you have a portfolio, once you have investments, how do you monitor it? Is it important to monitor your investments? Yeah. So let me tell you what Sister Sedgwick and I like to do. We use, as your portfolio gets a little larger, we might recommend you go to some personal finance software. We like Quicken because every week when we do our budget, it also updates all the portfolios for us. But that way we can monitor it. We did our budget yesterday just because we missed on Sunday. Sister said, the markets were down like 3% over the last week, and so it really kind of shocked her to see that.
But it'll go back. It'll go back.
You know, but we take a long-term view. We're not traders. Our goal is not to trade. But the thing we like, it allows you to automatic downloading mutual funds, your bank, credit card, other expenses directly into the system. So we encourage you to monitor your investment performance, not once a day, not even once a month, but we encourage you just to look at it now and then. So has anyone heard the term portfolio rebalancing? Anyone heard that term? What does it sound like? Portfolio rebalancing. Pardon me, go ahead. What is it, Christine?
You move money from one account to another to
right.
the right balance of asset classes.
Right. So because what you want to do is you want to maintain your risk level. What happens, let me tell you what's happened over the last 2 years. People who had large accounts, had large capped allocations. You know, what's happened the last 2 years? 3 years ago, they were off 18%, but the last 2 years, they've been up over 25%. So all of a sudden, their large cap allocation is higher than it should be. So they're actually taking more risk or less risk depending on the portfolio. And so why would you need to rebalance? Asset class performance. For example, the last 2 years, large cap were up 20% or 25% over the last 2 years. So you might want to rebalance to come back to your targeted risk level. You might have gotten married and you're aggressive and your spouse is conservative. So you might want to redo your asset allocation because you want to go to, you're now a moderate between the two of you. You might have gotten a big income tax back. So you want to invest that, and you're trying to figure out that. Or, you may have decided, before I didn't want to do emerging markets, and now I want to put something in emerging markets, so I'll have to take something out of large cap or something like this. So lots of different reasons why it would come up. What's the best way to rebalance? We recommend rebalancing about every year to 2 years. Not every week, things like that. But once a year, you kind of take a look at it. So is there a better way to rebalance? So what happens after each specific period? You rebalance back to your targets. We call a thing called NMD, New Money Donations Addendum. So the nice thing here is you pay yourself monthly. You're very careful in your selection of assets. Now you can combine that with your rebalancing strategy. So what do? Since we pay ourselves monthly and we're saving 10 to 20%, so generally we recommend that after you have your emergency fund, or if you're in the US, after you have your down payment on the home, after that, then what you do is you've got money coming in every month. What you do is you just buy your underweight asset classes, your asset classes that you're a little bit low in. So generally, these are the asset classes that have not performed. Again, we don't like to sell things because that creates taxable events. So the nice thing about this, it works both in taxable and retirement accounts. We use our new money just to buy the asset classes, or the mutual funds, to give us exposure to our asset classes. But what happens when you have an asset class that's done really well? So like over the last 2 years, large cap has done really well. Do we like to sell things? No, because it creates a taxable event. So finally, what's investment and valuation? Yeah, see how your investments are doing. Have they performed as well as they should? With index fund, is evaluation hard? No, you just say, okay, what did my index fund do? What did the index do? So generally, if they're good index funds, they'll be really close to the benchmark. You may be off a little bit, but they'll be really close to the benchmark. How about actively managed funds? Are those harder to evaluate? And the answer is yes. So what do we generally recommend? We like passive investments because they're very easy to evaluate. How have they done? And actually, the funds that you look at, or the mutual funds you looked at, have been around for either 5 or 10, more than 10 years. And so, again, we can probably expect that they'll probably be pretty consistent going forward. If you've got actively managed funds, which we don't recommend, evaluate them every 24 to 36 months. Take a look at them to see, are they beating their benchmarks? If they're not, you can always donate those in your appreciated securities and then buy the index fund. So lots of different ways of doing things. But it's important that you do evaluation.